Okay, let's begin. Good morning, Checkmate crew. It's 30 minutes after the opening bell of the New York Stock Exchange. It's 10 a.m. Eastern Time here on this Thursday, November 17th, 2022. It's Mickey Blindside here with your market memo. Okay, let's take a look at what's going on today. Overnight for us in the United States, but in the Eurozone, they came out with the CPI numbers, and it did not look very good. So here in the United States, at least in our CPI report, we saw the inflation numbers coming down. That is not the case in Europe. I think it may have come down just a little bit, but it wasn't enough. It wasn't like ours here in the United States. The Eurozone CPI came out at about 10.6%. Headline numbers, those are the headline numbers. The core is at 5. So, I haven't been able to, I didn't have time to check the actual report breakdown, but I'm sure a lot of it has to do with energy costs. And so we saw the Stoxx index sell off after that report. The DAX sold off. We also saw the euro currency also sell off as well too. And remember what I said, guys. A lot of the equity cues are going to be taken from the currency and bond markets. All right, and so I said the three most important currencies. If you include the dollar, it'll be 4. But it's the U.S. dollar, euro, the British pound, and the Japanese yen. You really got to take a look at those. Right now, all the risk on currencies are coming down. The dollar is going up. So we're seeing a little bit of a pullback here in risk assets and in the equity markets. Okay, so euro pulling back, British pound also pulling back. And that's why I think we're seeing a pullback in the Stoxx index. The Stoxx index is down about 0.5% in euro terms. But in dollar terms, it's down a little bit more than that. It's actually down about 1.1%. So as I told you guys before, I still have my FEZ put debit spreads for February. I still got the 36.31 put debit spread. We're about at break even now. All right, and so we'll see. I do think this continues. Remember, that was our levels that we were looking at on the Stoxx index. We were waiting for this level. We were waiting for this level here. We also were waiting on the DAX as well too. A lot of my levels were based on the German stock exchange. We were looking at that 13,800, 13,900 zone as a short. It did overshoot it just a little bit, but I think it does come back down. And what's my target? I mean, for some of you guys that are a little bit more conservative, you may want to start taking profits around 3,600 when the Stoxx index gets to 3,600. I'm going to take partial profit there, and I'll hold the rest. Maybe, and it really just depends on how it gets there. The slower it takes for me to get down there, the more profit I'm going to make, because my puts are dated pretty long. They're dated for February. Maybe I should have done January, but because it's February, because the gamma is so low, I kind of want this to grind lower. We'll see what happens. I'm willing to take profits if it goes down really quick, and I see that there's about to be a reversal around there. I might just take it all, but it just depends. But around that 3,600 zone, it would be a good area. For those of you that want to manage risk, that might be a good point to do an initial closing of the position for those who followed. So that's what I'm going to be looking at for the Euro stock. So I thought I'd give you that update. So Eurozone inflation still quite high. Okay, so we'll see what happens to that. They do have I think the ECB meeting, the rate setting meeting, I think that's going to be right before hours here in the United States. I may be wrong. I have to check on that, but I'll let you guys know, and I'll put it on the Discord on the countdown channel. Okay. So that's the Euro Stoxx index. let's just go through, everything else. Today, SPX coming down. It is gapping down today. Today, it's already down about 1.16%. It does look like as if the NASDAQ has relative strength today. A lot of that is, I think a lot of the weakness today is actually coming from value stocks and from smaller stocks. So we'll see what happens. This is our WIVE chart. It did pop up a little bit. It is coming back down. Again, if this is pointing down, it means tech stocks are set to underperform value stocks. All right. Let's just run through our indicators real quick. Our junk bonds ADL line, hey, has been pretty good in letting us know whether or not this rally has legs or not. And right now, even yesterday, even though the markets went down, the junk bonds advanced decline line actually had advances over declines, and so already we're actually seeing, what is it, 1, 2, 3, 4. Yesterday was the 5th day in a row of advances over declines, and right before then on the 26th we had 4 days in a row. Actually, that one was part of a 6-day stretch of advances over declines. So junk bonds, the liquidity data is improving. Okay, so don't blindly short the market right now. Those people who didn't have access to our liquidity data pretty much lost a lot of money in puts, and retail, just a typical retail, they went short heavy around this zone, around the lows, and so again, hey, that's one of the benefits of joining Checkmate trading. You get these liquidity signals. The junk bonds ADL has been a very, very good lie detector all year, and again, it's not slowing down. It's still improving. So again, guys, blindly shorting at these levels, I mean, it may work, and maybe we get a pullback, and maybe you might be able to profit just a little bit on this, but in the end, liquidity data remains supreme, and if you go against it, I mean, it's like going against the market. It generally is not going to be very, very profitable for you. That's usually how people lose a lot of money in the market. They just go against the market. Never fight against the market. You go with it, okay? And right now, liquidity data is improving, okay? Our New York high-low line has finally curved up above its first moving average. We need it to go above all 3 moving averages in order to have any sign of the bear market ending. We haven't had that signal all year. It's flattened out. It's even gone above 2 moving averages twice this year, but it's never gone over all 3. Okay, so it is starting to flatten out and starting to curve up. All right, our New York high-low line, and that's the 52-week highs. Stocks making 52-week highs in the New York Stock Exchange minus how many stocks are making 52-week lows. All right, so it gives you kind of relative strength of the components inside the New York Stock Exchange. New York advanced decline line. This is very similar to our junk bonds advanced decline line, where you're just looking at advancing issues minus declining issues. Right now, it is on an uptrend. It is right now. It is down today, but it's still higher than the lows. So could this be a higher low, and could it keep going up? It could, but we'll see what happens. This updates at the end of the day. We'll take a look, but it does look like breadth is still improving in the market, and right now the equal-weighted S&P 500 is pulling back a little bit from its 200-day moving average. Again, will it make that higher low? If it makes that higher low, then then we have a daily trend here that's a higher high, higher low. Okay. We'll see if that actually turns out. And again, if the equal weighted comes up, it generally means that a lot of stocks are participating in the rally. It's not just a handful of mega caps. Generally, if you see the S&P 500 going up, but you see the equal weighted S&P 500 going down, it usually means that all the rally is happening in the mega cap stocks. And we saw that back in 2018, 2019, 2020 as well too, where a lot of the gains came from the mega cap tech stocks. Right now, you know, for at least for the past 2 or 3 weeks, it looks like the market has broadly participated in this rally. Generally, that's a sign that this bear market rally can last a couple of weeks. Remember last time, guys, back when our liquidity data was flattening like this all around and improving, the last bear market rally we had, you know, had lasted us some time, remember? If we look back on SPX, remember on July 4th, after that weekend, we had 4 advances in a row in our junk bonds ADL line. We also saw the junk bond, our New York Stock Exchange high-low line also increase as well, going over those moving average, one of the moving averages. And if you remember, you know, that was what, a 6-week rally. Okay, that was a 6-week rally before it came back. So is it possible that this is also another 6-week rally? I mean, it could be. It could be. October 26th was when we had the 4 days, the first 4-day in a row of advances over declines and our junk bonds ADL. That would be around here. Okay, so 6 weeks from here, guess what? Guess when it falls on. 6 weeks from now is the next CPI report and Fed meeting. So isn't that quite a coincidence? I don't think it's a coincidence at all, but you know, I think the market is anticipating that. But again, you know, as long as our liquidity data remains in a downtrend, okay, I will short the market at 41.25 when the S&P 500 gets there. Now, if the liquidity data turns to the point where we're making higher highs on our junk bonds ADL, okay, which is, I mean, I guess which is possible, but I am not giving it a very high chance of that happening. I mean, if it gets above the August highs right here, if it makes a higher high and it gets also above our June highs, the end of May, early June highs here, you know, this is only 20 points apart from this high to this high. So if it makes a new high before we get to 41.25, then I may abandon that plan. Okay, the only way I'm going to abandon shorting at 41.25 when the S&P 500 gets there is if this junk bonds ADL line makes a higher high. Okay, and if that's the case, well, you know, that means something fundamentally has shifted in the market. And you know, I'm not going to blindly short if everything is telling me not to do that. Okay, so it all depends on this data. All right, everything I do is based on this data. All right. So that's the S&P 500. That's our liquidity signals. Today, as promised, I wanted to go over some of our other plays that we have as well too. Today, some of you all expressed some interest in UUUU, or the quad U's. I'm going to call it the quad U's from now on. People said that when I say the ticker symbol, it sounds like I'm making baby noises, but I'm not. It's just 4 U's. That's the ticker symbol for energy fuels. That's the uranium name that we're in. It is pulling back. I do have those 8 strike calls for December. Right now, I think a lot of this has to do with the Australian dollar coming down. The Australian dollar hit this level. Remember, this was our make or break level in the Australian dollar. We took a trade on this, remember? Actually, no, we did not take a trade on this. I took a trade on it here. I went long the Australian dollar right here. Of course, I took profits way too soon. I think I took profits like around here or so, right when it went above this green line. Of course, I took it way too soon, but this was our make or break level. Remember, this is what got us into the China trade. It bounced here, it failed, and that's when we got into our FXI puts back in the summer, remember? And I said, if it breaks this, then that's going to be really bad for the Australian dollar. Then it's going to really sell off. And lo and behold, it did. And this was our make or break level. I haven't changed this chart at all, except when I added this line. These lines have been in on my chart for years. This line I added back in the summer. I didn't move this, but it looks like that is where the Australian dollar went up. It retested and it's breaking down from there. Okay. And I think if it closes below here and it closes even lower, we might even see lower prices on metal miners in general, because not only is the Australian dollar a good forward indicator for China, it's also a pretty good indicator of what's going to happen in the metal space. All right, XME is very, very correlated to the Australian dollar, and there's a lot of uranium names like CCJ, which is the largest uranium name in the United States. CCJ is in XME, and a lot of the uranium stocks take their cue from CCJ. But again, if the Australian dollar really sells off, this could come down. For those of you that are not in it, I mean, anytime it gets under $6, I think that's a buy. Okay, I bought around the 697. I also bought again around 550 right here. Okay, and I have another order right around here, this 475, 450 zone. I have another order right here to double up on shares. Okay, so I have even more orders if it comes down. But again, that's my plan. I've already legged into this. Who knows? It might just go up. It might not. I have no idea. But for UUUU, just so that, or Quad U, I am short the $8 calls. Remember, I originally had sold the November calls and used that premium to buy free puts. Those puts are going to go worthless, and that's why I do the collar trade. I like selling calls and buying puts with them because that makes the put hedge free. But yeah, that put hedge is not going to work out. The one we did in October gave us a really good payout, but that's not what happened this round. So it is what it is, all right? Metals. Let's talk about metals for a second, all right? I wanted to share with you guys another play that I am getting into is PLG. I'm really bullish on platinum, guys. I'm really bullish on precious metals, but I'm super bullish on platinum. Oh my goodness, when I looked at the market opening today, it missed my alert by 1 cent. Look at this. You see this, guys? I don't know what's been going on this year. This whole year, every time I set an alert, literally the market comes within like pennies of it and then bounces off of it. I have no idea why it's happening. I think the levels that we're creating are pretty accurate. It's just the market is just not fully going down there. Literally 1 cent. I can't even make this up. Guys, I can't even make this up. Literally 1 cent away from our level, my initial level. I mean, that's the market. That's life, that's trading. But all right, anyway, if the Australian dollar keeps going down, I can see other metal miners continuing down. I would love to get a crack at PLG. PLG is a platinum group metals. It is a low dollar stock, so there is some risk to this. So keep that in mind. Keep your position sizing appropriate for a stock like this. A stock like this can be very, very volatile, especially low dollar stocks. It's stocks that have very lower volumes. This stock generally has around 200 to 500,000 shares of volume. Sometimes it gets into the millions, not all the times. Generally, it's around that 200, 500 range. So again, it's not the most liquid of stocks. Again, 200,000 to 500,000 is really not all that much, considering the millions and tens of millions, even up to hundreds of millions of shares that are being traded on some of these mega cap stocks. But again, I'm very bullish on the platinum price. Platinum, precious metals, all of these tend to go up whenever we see currency debasements, and precious metals tend to be a hedge on currency volatility. It's not a hedge necessarily on inflation, but it's a very good hedge on currency volatility. And platinum also has the added benefit that it is also, not only is it a precious metal where they mint coins off of it, they also make jewelry from it, but they also use it for industrial reasons. Right now, platinum and palladium are also being used to make electric vehicle batteries. And one of the businesses that the platinum, at this company, PLG, one of the businesses that it is in a battery company. I believe they call it Lion. Let me just take a look. I actually have their last earnings report right here. Yeah, Lion Battery Technologies. They have a joint venture with another platinum and palladium miner, and they have a 50-50 joint venture into Lion Battery Technologies. You know, they invested 50-50 each, and so it's a fast growing part of their business. One of the other reasons why I like Platinum Group Metals so much is because they have very, very low debt. All right, they're very, very low debt. They have a decent amount of cash. They have earnings growth, and not only are they in mining, but they're also in battery technologies as well too. It's an all around. It's a great story to be in. You know, I like the fact in this rising interest rate environment that it has no debt. You know, to me, that fundamental is very important. So PLG, again, this is a very good stock. In the last commodities boom, okay, this stock was, you know, $400, $500. Now, do I think it's going to go back up to those levels? I don't know about that, okay? I don't know about that. But if palladium prices, you know, right now they're about $1,000 or so for a palladium contract. You know, if palladium can get to above 1,000, let's say it can get to around 3,000 or 4,000, which is very possible. Okay, if gold starts running and everything, palladium can also run too. I mean, we're talking about this. It could. The share price could get into like the 50s and 60s. Okay, that's a huge multiple. And some of these smaller metal miners can run like that in a commodities boom. Okay, go take a look at the chart on some of these metal miners. You know, junior metal miners from 20, 30 years ago. You know, they were, you know, $4, $5, and they would all go up to like $70, $80, $90 during the commodities boom. So it's possible. I'm not banking on it. And again, this is a lower dollar stock, so I'm probably going to have a smaller position size on this because it is inherently a little bit riskier. But these are the levels I'm looking at: 160 and around the 140 zone. Okay, I was going to leg in on both, but literally missed it by a penny. You know, this is a very, very small buying zone. I may even just move all my buying down to 141, and it just really depends on what happens to the Australian dollar today and tomorrow. So if the Australian dollar, I think if it starts really breaking down, and if it closes here and then tomorrow it even closes lower, yeah, you know, I might move all my orders down to 141, that 140 zone. Oh, look at that. Look at that. That is not pretty, okay? So if it can maintain this weekly candle right here on an Australian dollar, I think that's a very good case that the Australian dollar may fall back down, and that may cause some of these metals to come back down, some of these metal plates to come back down. So we'll see, okay? We shall see. So that's my thesis on PLG, okay? So that's my next target is I'm going to go after PLG, which is a platinum miner. And yeah, so this is the next play. One other play that I actually wanted to go over to was actually, well, it's a play and it's also data. It's data from the Federal Reserve Bank of New York. I've been looking at some credit card and credit delinquencies in this country, and one thing that I noticed on the quarterly report from the New York Fed was that the transition into delinquency, so you know, credit that's been delinquent now for 30 days is rising. It is rising. Look at that. Credit cards, it's rising. All right. Also, too, with transition into serious delinquency, 90-plus days, also going up. They also have raw data on this. You can actually download a spreadsheet that has all of this. I downloaded it. I've been monitoring this now. So right now, you know, as you can see, auto loans, this is, what is this, new delinquent? This is the 30-day, okay? 30-day auto loans have been going up. You know, this is about 60 basis points. Credit card delinquencies have gone up about 50 basis points. Mortgage has gone up about 20 basis points in 30-day delinquencies. And then if we look at more the 90-day more serious delinquencies, those are going up as well too. Okay. And we've been talking about this. We've been talking about this for a while. Remember, around July 12th, if you actually go back to our videos and our video section, this is not on any of our playlists on our YouTube channel, but back in the day, we had this Say What session, right after the calls. Some of the people that would hang around in the Discord, we would talk about new trading ideas. So back in July, we actually were talking about a retail short. That's XRT. That's the retail ETF. We were thinking about shorting that based on credit card delinquencies. And we've been talking about this since July. And I think we're starting to see the beginnings of those delinquencies coming up. And so usually when the delinquencies, they start coming up like this, that is a good opportunity to short retail. All right. I really want to see these credit card delinquencies get up to like 5-6%. And that's when we can start shorting retail. Okay. On pops. All right. Speaking of retail, the level, and I didn't change this chart since July, the level that we were looking at was around $78, $77. I can't believe it, but just like a month, 2-3 months ago, it was literally like 2% away from that level. Look at these levels. These levels are really good. It came within 2% of it. I do think that if we do see a bear market rally that lasts a few weeks, this could get up there. Okay, this could get up to like, this zone right here. And if credit card delinquencies by that point, hopefully the Q3, Q4 numbers will come out. And if that's the case, and if delinquencies are still going up, I may attempt a short. Now, this is a good level to short. It's even better if we can get 90. All right. So it may take a couple of quarters for those credit card delinquencies to start going up. And at that time, if we're close to this area right here, oh my goodness, that would be like the mother of all shorts right there. So that's what I'm looking at. It's going to take a few quarters for this to play out, in my opinion. Okay, so this is a more longer-term play that to monitor. Speaking of XRT, I think right now the XRT is down for the week because of Target, right? Target had some really bad earnings. Yeah, they had really bad earnings. And I remember too, around July, August or so, that was around when they were talking about their inventories being so high and they might have to slash their prices to make way for new inventory. Remember, I think Walmart also sold off on that initial news, but then popped up on the earnings just because the earnings came out better than expected. It was right here. Yeah, it was right here when that announcement came out, when a lot of retailers came out and said they have excess inventory. It was this date right here around beginning of August. Okay, Walmart had earnings. Walmart had better than expected earnings. So right now we're seeing a mixed bag in the earnings when it comes to earnings for retail companies. All right, Walmart did well. Target didn't do so well. I'm kind of curious to see what Dollar General does. I think Dollar General, I think they are going to report pretty soon, no? Maybe in a couple weeks? Perhaps in a couple weeks, okay? But Dollar General, that's going to give us a good tell. Generally, when we see the Dollar General, when they start seeing pressures, because they're a discount retailer. So when you see Dollar General start having problems with sales, that's a really bad sign. That means the consumer is really, really weak. And I think that's going to be more the case when we have those delinquencies go up. But until then, I'm going to just hold tight. Again, XRT, that's the play. And there's no real level per se. I mean, obviously, it would be nice if we can short it at 90, but we also want to see those credit card delinquencies go up into like the 5% range before I short, just to make sure we get the most out of that move. So I'm waiting for that credit card data to turn. Okay, and you guys can check it yourself. Again, it's on the New York Federal Reserve website, the NewYorkFed.org. All right, and you can just go to their data bank and download it yourself right here if you want to. It's all free. Yeah, it's good stuff. What else? Today also too, I wanted to talk about crypto. I know a lot of you guys are talking about it. Right now, crypto is selling off. ETH right now is under 1200, if I remember correctly from earlier today. Yeah, ETH is, oh no, it's at 1200 now. It popped back up, I guess, after the markets open. So ETH is at 1211, Bitcoin's at 16,654. We're still ways away. Again, my next buying level for ETH is when it gets to the ETH gold ratio gets to 0.57 now. It is an upward trending line, so now it's at 0.57. That would imply around $950 to $975 per ETH coin. Based on today's gold prices. So we'll see if it gets there or not. I am not monitoring the options data on Ethereum anymore just because the OI is so low. Right now, the open interest, the OI, is the nominal value is less than $5.5 billion. Remember, we were at $8 billion like right before the merge. After the merge, it kept going down to $6 billion, down to $5 billion. And then afterwards, it went back up to 7, and now we're, because of this whole FTX situation, now it's back down to below $5.5 billion again. So when the options OI is that low, I don't think it affects price all that much. But right now there is this fear of a contagion effect. And when they say contagion effect, I don't think what they're talking about is the S&P 500. The crypto market is really, really small market, okay? And just to show you guys, there's a good visual. Oh, yeah, all the world's money. This is it. Okay, so all the world's money, I mean, if you look at crypto, and this is back in 2020 prices when prices were way higher, okay? You don't have to take my word for it. Go back in 2020, look at it. And back around 2020 for Bitcoin, all right, we were around these levels, okay? We were around these levels. It was done around May or so, so I guess we were around these levels. Maybe a little bit higher right now. So maybe there is a chance that the crypto market has grown a little bit since they created this visual, but still it really hasn't changed all that much. It's still a very, very small market, okay? Just to keep things in perspective, I think the amount that was lost in Facebook stock in market cap is actually bigger than all the crypto market combined. Okay, or very similar to it. All right. So when I say contagion, this is all within the crypto market. There is a risk that is spreading from one crypto company to another. Basically crypto right now is having a Lehman moment where there was a lot of lending from one firm to another. All right, lending from one firm to another, leveraged lending. Very poor risk management on hedge funds and all these different players that are in the crypto space. So, when FTX goes belly up, all of these companies that had lent or had assets at FTX or invested in FTX, they're all starting to have liquidity crunches, and they're all starting to have solvency issues. So Genesis now is on the news. Genesis, the crypto brokerage, has loans that they made out, and now it looks like as if they had to suspend some redemptions in their lending business, and also to Gemini Trust is also in the news, which is the Winklevoss twins crypto exchange. They had to also halt withdrawals on their lending program. So right now, there's a lot of fear that a lot of these companies, a lot of exchanges may go under because of this. Which is interesting because I think that's actually a bullish case for decentralized finance. If you actually look at it right now, most of the crypto failures have been centralized exchanges, not necessarily the DeFi protocols. The DeFi protocols, Ethereum and Bitcoin, they all did what they were supposed to do. They're holding up and they're not collapsing. It's these centralized exchanges where improper risk management happened. That's where all the problems are. Okay, so I think that actually after all of this, crypto may actually bounce back stronger I do think that a lot of the altcoins will go away. I think in about maybe 2 to 5 years, there's going to be regulations around altcoins. They'll probably do away with altcoins. But all that money in those altcoins, I think, will make its way into Ethereum. All right. So I actually think in the longer term, like 5+ years down the road, this is actually a bullish thing for Ethereum and for decentralized finance as a whole. But in the short term, though, I think there's going to be a lot more pain. Again, it's a Lehman moment. There's going to be a washout, but we'll see. Okay. So that's my crypto section of the day today. Anything else you guys want to look at? Anything you guys looking at, or any questions you guys have? Going once, going twice. Okay, in that case, we will call it a day. We'll wrap up our session of the morning market memo. Our Discord invitation link is in the description below. Come join our Discord. Be a part of a growing community. There's no sub fees. There's no paywalls. It's of the people, by the people, for the people. And if you enjoyed our video, go ahead and hit like, follow, subscribe, comment, show us some love, baby. All right, I'll be back on next week, Tuesday, Wednesday, Thursday, as always, 30 minutes after the opening bell on New York Stock Exchange. If I have some time tomorrow, I'll try to do another video tomorrow too. I know today we ran out of time here and I wasn't able to go over the food thesis. There's one more stock that I wanted to go over for food, and that's Vital. VITL is the ticker symbol. We already kind of talked about it just very briefly on Tuesday's market memo, but I'll do a deeper dive on it, and hopefully I'll have some time tomorrow, and maybe I'll publish that video tomorrow, and I'll let you guys know in the Discord if that happens. All right, guys. Well, in that case, have a wonderful day, trade safe, and I hope to see you guys tomorrow. Have a great day.